Hello, I'm Omid Shakurnia, partner and head of research at Research Affiliates, joined by our founder and chair, Rob Arnott. Today, we're discussing our recent findings on the historical level inflationary episodes around the world and looking at what those periods can inform us about our current and prospective inflationary environment. In our recent paper, History Lessons How Transitory is in Inflation, we study inflationary surges across 14 developed economy countries over the past half century. Now, it's a market truism that high levels of inflation coincide with high volatility of inflation. Um, that everyone knows. What we seek to highlight and study is how sticky inflation can be, and get a sense for the amount of time, once we've experienced an inflationary surge, the amount of time it takes for inflation to revert back to normal levels. What we find and what history tells us is that once the inflation genie is out of the bottle, it can take far longer for inflation to come back to normal levels than what most people realize. Now, before we dive into the presentation, I have just a few reminders. We invite you to submit your questions during the webinar using the Q&A buttons. We also have a list of resources for download, including this paper, the How Transitory is Inflation, the slides, and a link to our asset allocation interactive website, which includes both our long horizon capital market expectations, including our global inflation views. So, the current inflationary environment, we all know inflation uh, has been elevated over the past year and a half in the post-COVID era, and we've seen levels of inflation not experienced over the past 40 years. It's been a global phenomenon, with inflation levels at the U.S. running as of the end of 2022 at about 6.5%. UK and Germany inflation running at about 9%, and Japan uh, with inflation levels at around 4%. These inflation levels have caught the market by surprise. When we look at a measure of inflation surprise, defined as the realized level of inflation minus expected inflation, we see a positive inflation surprise not experienced in 30 or so years. Uh, Now, what is our measure of inflation expectations in creating this inflation surprise measure? It actually doesn't really make much difference. Whether we use the survey of professional forecasters, the Federal Reserve Bank of Cleveland inflation expectation, uh, or a very simple exponentially weighted moving average of recent inflation. All of these measures give about the same level of inflation expectation and inflation surprise. Now, Rob, we have a question from a registrant that is very pertinent, and you can see it on this slide as well. Hasn't inflation already come down? If you look at just the inflation prints over the recent 5 or 6 months, um, isn't inflation on its way down? Is that perspective wrong?
Absolutely not wrong. It becomes very interesting when you look at past levels of inflation. There's a lot of things that aren't well known about CPI inflation. We've addressed in a past paper the fact that doesn't use home prices; it uses owner's equivalent rent and rent of primary residence, both of which are deliberately and consciously smoothed and lagged relative to what's actually happening in home inflation and rental property inflation. We also have alluded to the fact that every single month, when a new inflation print comes out, you're adding a new month that in advance you don't know what it's going to be. And you're dropping an old month from a year ago that you know with precision. You know exactly what's being dropped. Now, coming into 2023, we have a very interesting situation. First half of 2022 is when roughly 90% of the full year inflation occurred. About 6% inflation for the first 6 months of the year, barely, not even 1% inflation for the second half of the year. Very, very interesting and stark differential. What does that mean and why should we care? It means that in the first 6 months of the year, we're going to be replacing high inflation prints with unknown new inflation prints that might be low, might be negative, might be high. We just don't know. But you're replacing high inflation prints. So the dashed orange line on this graph shows what will happen to the year over year inflation if each new month matches the prior 36-month average, meaning the COVID span, the COVID deflation brief, and the aftermath, the inflationary regime since. Well, first half of the year, you're replacing very high inflation rates with low rates that the 3-year average is about 0.4% a year. You're replacing inflation that's nearly 1% a month with 0.4% a month. And so inflation would be expected to tumble from 6.5 to 3 in the first 6 months of the year. Second half of the year, you're replacing that very low 1% inflation achieved in the entire 6 months, with the result that you'd be seeing inflation ratchet back up from 3% to 5.7. Now, remember, every single month here, we are assuming that inflation is the same, that same 0.4%. And the result is a nosedive in inflation and a soaring of inflation, meaning that the nosedive in inflation is an illusion. Dropping from 6% to 3% is an illusion. Rising from 3% to 6% is an illusion. So we can reasonably expect a lot of economists, politicians, patting themselves on the back the first half of the year. See, we've got this demon under control. And the second half of the year, egg on their face. Uh-oh, it's rising again. All of it illusory. The reality is that's more or less a straight line from 6.5 to 5.5, assuming that you're replacing past months' inflations with new months that are all the same. What if those new months are all the same at zero? Well, then of course you finish the year at zero inflation, but you get almost all the way there by June. Wow. So this is a very interesting element of the inflation puzzle that gets far too little attention, especially since it's predictable with such precision. On a longer term basis, there's a lot of forces that can push us towards lower inflation or towards higher inflation. The left tail forces are self evident. Technological innovation automatically reduces the costs of goods and services. And so there's this natural, an evolving economy should be deflationary. There's also a global race to the bottom to debase currencies relative to the dollar. And we saw the dollar strength until not too long ago. Jim Masturzo recently just issued a report from us that takes a deeper dive in this and concludes that that surge is probably about the end of it. High public and private debt levels also can result in deleveraging and deflation. So you have a number of things that can push inflation lower. You also have a number of things that can push it higher. Bipartisan embrace of modern monetary theory, embraced enthusiastically by both Trump and Biden. Ouch. MMT basically says you can print whatever money you want in order to fund whatever government programs you want, as long as when inflation kicks in, you're willing to raise taxes to pay for it. Now, that latter part is politically difficult. The early part is politically easy. We've seen bipartisan embrace of liberal spending and bipartisan unease about raising taxes. I'm not suggesting we should raise taxes. I don't think we should. But I also don't think we should be spending like drunken sailors. The acceleration of deglobalization can also be a right tail force. Deglobalization is inherently inflationary. It eliminates the natural competitive advantage of one nation over another that allows one nation to provide goods and services cheaper to another nation in exchange for goods and services that the second nation can provide cheaper. That's win-win. That reduces costs. And shifting to a net zero economy, to the extent we actually embrace the ESG policies that are advocated, if we embrace them wholeheartedly, that becomes massively inflationary. If we embrace it in a modest way, not so much. So, as Omid said, we looked at 14 countries. If you want to look at the behavior of inflation in the US and try to gauge what may happen to current inflation based on US experience, you sure don't have a whole lot of examples. But we looked at 14 developed economies around the world, basically all of the economies, developed economies in the OECD universe that were already developed economies in 1970. So Turkey, Mexico, they're out. But the economies that were already developed in 1970 represents a fair selection universe. And what do we find? We find going back to 1970, 53 years of history, there have been 67 times when inflation exceeded 4% in at least one of these countries. And our threshold for gauging whether inflation is back under control is that it gets back down below 2%. What do we find on this graph? 67 total episodes. Of those, let's look at the categories. The bottom category, accelerating with multiple peaks. That means it got to 4% and then it crossed the next threshold of 6%, maybe 8, maybe 10, maybe 15, maybe 20, and eventually receded. Accelerating that have been resolved, that's the next band. That means they've gone back down to 2. It's a finished, closed book. Accelerating and not resolved, that's in the bright red. So right here you can see there's about 10 episodes underway right now that are still above 2. And cresting not resolved. What does cresting mean? It means it didn't go to a new high. It didn't go above the next threshold of 6%. And so these are all episodes that have not achieved 6% inflation, but also are not yet resolved. They may be accelerating inflation before they're over. They may be continue to be cresting and go all the way back down to 2. We just don't know. The dark blue are cresting inflation that's resolved, and the really skinny dark blue up at the top is cresting inflation with multiple peaks. What's that? It means you went to 4%, you didn't get to 6%. You went back down below a 3% threshold, and you went back up above 4 before you ever got to 2. Multiple peaks. So we break the nature of inflation down. If you've got 67 different samples, you can break it down into a lot of different categories and ask what the heck happens. And first thing I would draw your attention to is very nearly half of the time that inflation rises above 4%, it recedes. It never goes above 6. Why? Very simple. 4% inflation can be caused by an exogenous shock that has nothing to do with policy within the country that's experiencing the inflation and that simply dissipates just naturally. Getting above 6% inflation, now you've got about 80% of them go on to new highs above 8% inflation. Only a modest fraction do not. At 8% inflation, the vast majority go on to 10 or higher. Very few have receded without going to higher levels. And as you look at 8% and up, you find that the vast majority go to still higher levels. We crossed 8. We did not cross 9. So this particular sample is particularly important for the US. Now, don't get us wrong. We are not saying inflation won't recede below 2% in the next year or two, and that this was a reasonably benign short burst of inflation. We are not saying that. What we are saying is that that falls into this little category here, 8% subsequently resolved. And you have all these other episodes where you went on to further difficulty. All right. So my takeaway from this is very simple. This little example here should not be our central expectation. We shouldn't anchor on it. The economics community, the policy community, government, and the investment community, the capital markets, are all saying this inflation has been reasonably brief, is reasonably benign, and is going back down to lower levels. They could easily be right. They could also easily be wrong. This exhibit shows the length of time it takes to get inflation back down to a 2% target. Now, I'm dividing here between cresting inflation, which is lots and lots of cases here. 4% inflation is often cresting inflation, and accelerating inflation up here where it goes on to new highs. Then the gray band is the middle three quintiles. So here for the 4% inflation, you've got a little over 2 years to get back to historic norms if it's cresting inflation. We crossed 2% back in, we crossed 4% back in early 2021. This would say if it never got to 6%, 2 years and a few months is enough time on average for you to get it back down to 2%. But 80% of the time isn't quite that simple. 80% of the time, you have anywhere from 3 years and change to about 18 years before inflation gets back down to 2%. The median is 8 years. Now, that's with the 47 samples out of 67 that have been resolved. So 20 of the 20 of the cases aren't in here because they haven't been resolved or because they weren't unique episodes. I'll come back to define that in just a minute. 8% again is the most important threshold because it's the one that the US exceeded without crossing 10. If this is truly cresting inflation, history tells us 3 years and change to get below 2%. Well, we crossed 9% late last year. 3 years and change would mean sometime in 2025 or early 26 would be the median time to get to 2% inflation. That's longer than most people currently expect. If we see a surge back to new highs, then we're looking at 16 years as a median expectation. And the overall median is about 13 years. These are daunting numbers, but this is what history suggests. Am I saying that this should be our central expectation, that it's going to take 13 years to get things under control? No, we're not saying that at all. What we are saying is don't anchor on this as your central expectation. That's very dangerous. Have part of your portfolio and part of your expectations set to acknowledge these possibilities. This exhibit, which we call our spaghetti chart, shows all 67 episodes of 4% inflation. Now, the ones that end in a dot are ones that are still underway. Okay, that's interesting and useful. The ones that are in red all went on to new highs above 6%. So those are all accelerating inflation. The ones in green are cresting inflation. And the cresting inflation usually comes back down reasonably quickly to 2%, 12 months, 24 months. But there's a few outliers where it never got to 6%, and yet it still took 8 years and change to get back down to 2%. The red lines, which is slightly more numerous than the green lines, the accelerating inflation, the ones that have been resolved, you got one here where it went on to new highs and still got under control in only a year and a quarter. Well, that's pretty cool. The next one out there is just past the 2 year mark, and the worst, slowest return to normal was 26 years. Um, this is the median. This is what I was alluding to earlier. 13 years is the median. Uh, None of this is to say that current benign expectations are impossible, nor even that they shouldn't be acknowledged as a very reasonable outcome. It could easily happen. But we should also recognize that this can also easily happen. Our next spaghetti chart is for the one relevant to the US experience today. Now, these exhibits are through September, so they don't bring inflation up to date through year end, but there are 8 episodes of inflation above 8% that are still underway. Those are the blue dots at the end of a red or a green line. 2 of those had fallen by September back down below 8%. So they're a green line, cresting inflation. This is the US right here. It's since come down to about this spot on the graph. Now, of the resolved episodes that have reached a conclusion, 2 of them, only 2 of them, came back down to normal levels to 2% inflation within 2 years. I think the market is kind of anchoring on this as an outcome, 2 year horizon, or maybe even one of these. This is the central expectation. If history is a guide, that's a dangerous central expectation. It's not dangerous to acknowledge it as a very real possibility. This line shows the median outcome, 15 years and change to resolve 8% inflation, with out of all of the resolved cases, only a half dozen were less than 7 or 8 years. When you get to 12% inflation, which 2 countries did, Netherlands and the UK, you have a interesting challenge. Firstly, there's only one episode of cresting severe inflation where it doesn't go to 14% and does come back down below 2 in reasonably short order, just 18 months. I mentioned unique episodes. That's actually the tail end of an episode that started 13 years earlier. So 13 years into it, it was still 12% plus. And then it took just 18 months to fall back down to 2%. So that was not a unique episode. That was the tail end of a multiple peak episode. The only cresting episode of severe inflation that didn't go to new highs, that didn't go above 14%, was this episode. And yet it took 17 years for inflation to get back down to 2%. When you get severe inflation, we have it in 2 countries. The norm seems to be that it takes 6 to 20 something years. The median outcome is it takes 19 years. This is not a pretty picture. So our cautionary note is not that transitory is a naive hope that can't happen, but that it's a naive central expectation. This exhibit shows us how far behind the curve the Fed was. In the pandemic months, the inflation rate was essentially 0, dipped negative briefly. Now, there's something called the dot plot that's produced by the Federal Reserve Board, in which each member of the Federal Reserve estimates where the Fed funds rate should be at the end of the current year, at the end of the next year, at the end of the following year, and as a long-term target. All right. This shows the Fed's view in June of 2020 as to where the Fed funds rate ought to be by the end of 2022, 2.5 years later. All but one Federal Reserve governor said it should be in the 0 to 0.25% range. Basically, call it 0. One Fed governor thought it should be an eighth of a percent higher than that. 6 months later, one Fed governor thought it should be half a percent higher than that. The rest of them were all anchoring on zero. End of the year, the rest of them were all anchoring at zero still. Now you'll notice that inflation over the prior 12 months was 1.5% coming into 2021. Pretty darn benign. So this outlook down here is totally unsurprising. It's very reasonable. Coming into March, this is the inflation through March, over 4%. This is when Jerome Powell coined the expression transitory inflation. He said this inflation is transitory, not to worry. The central bank at the end of March or mid-March still was anchoring on zero. You had five Fed governors who thought by the end of 2022, which was now a year and a half away, the Fed funds rate ought to be a little higher, but not much. And this was in the face of 4% inflation. Now, what bothered me about this was that 4% inflation, over 2% of it had happened in just 3 months. 2% in 3 months, that's 8% annualized. So you had 8% annualized inflation, 4% year over year inflation, and the Fed chair says this is transitory, not to worry. Ouch. Come into June, expectations are up a little higher. The feeling seems to be we got 5% inflation, not to worry. We should still have Fed funds near zero at the end of next year, 2022. September, a few more, thinking maybe it should be a little higher. December, now all of them have ramped up. There's nobody left in the zero camp. But where were we? Before that December meeting, inflation had just crossed 7%. Okay, now that's interesting. You had 7% inflation. You had the median expectation for Fed funds at 7/8 of a percent, meaning 600 basis points behind the curve. In November, Jerome Powell said it's time to retire the word transitory. This is not transitory inflation. And yet, not a single Fed governor, including Powell, thought that by the end of 22, the Fed funds rate should be above 1.25. Not one. Yikes. 3 months later, they started getting religion. 3 months after that, a little bit more. After that, a little bit more. The most recent was a little higher still, but still well behind the curve in terms of inflation. So the Fed has finally woken up to the fact that the inflation surge is real, and inflation is now coming back down. It'll be interesting to see whether this goes up or this comes down before they cross, but they'll cross at some point. Which leads into a couple of questions that came from our audience already. One of them was asking, okay, so what do we think inflation will be in the coming years? And what asset classes can protect us against inflation? Omid, I'm going to pass the baton to you for that.
Thank you, Rob. Well, what we're looking at here on our screen is our 10-year inflation forecasts on a country by country basis. You can find these on the Asset Allocation Interactive site. What we see is, while likely to moderate, inflation is poised to be higher for longer, definitely higher than what we experienced over the last decade. On the left, we see developed markets averaging a bit above 3% inflation, while emerging markets average across emerging markets is running around 4%. Now, inflation is notoriously hard to forecast at very long horizons, and I hope what Rob has convinced you is, as point estimates, these have very large uncertainty bands around them. They can run higher or lower with a pretty big uncertainty. And one of the things that we try to emphasize here is to portion a part of your portfolio for the risk that inflation can run higher than these central tendencies, as well as lower than these central tendencies. Now let's look at what asset classes perform across different inflationary episodes. And what we're looking at here is asset class returns across what we call the inflation cycle. If you recall from one of the earlier slides, we looked at the level of inflation surprise as defined by realized inflation minus expected inflation. Uh, on this chart, we used a simple exponentially weighted moving average trend as a proxy for expected inflation. And when we see that inflation is running higher than those expectations, we find a very interesting result. If we divide the regimes in high inflation surprise regimes and negative inflation surprise regimes, that decomposition, uh, on average, you're dividing time into about 50 50. Half of the time by construction, because we're using trend inflation as our proxy for expected inflation, about half the time inflation will run higher than trend, and the other half inflation will run lower than trend. Currently, we're running well above trend inflation. We're in a extreme kind of inflationary surprise environment, and that's the environment that we find ourselves on the left half of the screen. How do asset classes perform in this environment? Well, we see that uh, without too much surprise, we see that commodities, REITs, tips, these are kind of real return oriented asset classes. These are the ones that provide some level of protection in high inflationary surprise episodes. At the flip side, we see equities, long term bonds. Those are the ones that get hurt the most in high inflationary episodes. And so, you know, the natural question is, how can we position our portfolios to respond to this environment? Well, very simple. You take off a little bit of equity beta, you take off a little bit of duration, and you favor asset classes that provide protection, and real return oriented asset classes like commodities, tips, and REITs.
Omid, one other thing that I would add to this that I think is very interesting is that the asset classes at the top of the roster, those are what we like to call third pillar assets, assets that are diversifying away from the asset classes that we mostly concentrate in. US core bonds, not very helpful in an inflationary regime and not highly rewarding in a disinflationary regime. Mainstream stocks, not very helpful in an inflation regime, pretty good in a disinflationary regime. So you get some interesting stories here. But emerging local currency bonds, beautiful in a disinflationary regime, hurts you hardly at all in inflation. Emerging US dollar bonds, same thing. Compare that with long term bonds in the US, where the payoff pattern is not nearly as benign. Short term bonds, not very useful in either environment. Therefore, that's your risk off asset when you're just waiting for opportunities. But these are third pillar markets, away from first pillar mainstream stocks and away from second pillar mainstream bonds. This is what we think is the sweet spot for the 2020s. I'd also note that a lot of our discussion has been focused on inflation surprise based on a prior expectation and what actually happened over the next year. There's another measure that bears some careful consideration, and that is what's called break-even inflation rates, the difference in yield between treasury bonds and the corresponding tips. The tips are inflation index bonds. Current yield is 1.5, give or take, for the 10-year. The 10-year Treasury bond is in the 3.5 plus range, meaning that the break even rate of inflation at which those two instruments will have the same return is about 2.25%. Well, 2.25% over the coming 10 years means the Fed hits its target next month in terms of inflation and stays there for a decade because that's its target. So, one very simple takeaway for us is we're expecting 3.5 inflation for the coming 10 year. If you have 6.5 now and 5.5 in a year and 4.5, it's going to average well over 2. So, one of our takeaways is don't invest as if 2.25 is going to be your 10-year inflation rate. We don't think it will be. Thank you for your time. Let's open it up to whatever questions there are.
Now on to our Q&A session. Rob, we have a question from a registrant. Given the uniqueness of today's macro situation, what historical insights give you a high degree of confidence in your forecasts?
Well, firstly, if there's any takeaway from this entire presentation, is that we have no confidence in our forecasts. And what we're pushing back on is the fact that so many people have so much confidence that this inflation is on its way out and that a benign outcome and perhaps a soft landing up for the economy is the base case, the high odds base case. So we're not saying that we have high confidence. We're saying invest your money and plan your business with a recognition that there is a right tail and that right tail does not have zero odds. It has reasonably high odds. So our inflation expectation for the coming decade of 3.5%, tacitly implies that you're just as likely to have 2% as 5%. 5% inflation for the coming decade? Ouch. 2%, that's the soft landing side. So tacitly what we're saying is be aware that there's a right tail and plan your businesses and your investments accordingly.
Great. We have another question that I'll take in this case. Do inflation protected bonds actually work if rates rise? Now, inflation protected bonds, TIPS in the United States, these are specifically designed to protect against rising consumer prices. The face value of TIPS is pegged to the CPI, and that value is changed with changes in the rate of inflation. So the TIPS pay interest on the adjusted face value, and as inflation rises, investors in TIPS should see interest payments rise correspondingly. But TIPS are still fixed income investments. You can think of them as having two parts. They have the inflation protection piece, and they still have the duration piece. They are still sensitive to duration risk. And so while they give you much more inflation protection than nominal bonds, they still have that duration component. And when interest rates rise, they will take a hit, just as other fixed income investments do. And so, I wouldn't expect TIPS to be the end result of your search for inflation protection. That's why we research affiliates, we like to think about a broad variety of asset classes that provide inflation protection. And TIPS is just one part of that.
If you want to lock in 1.5% real return for the coming decade, or a little more than that for the coming 30 years, it's a great way to do that. But is 1.5 real return really our goal? And for taxable investors, it's worse because you're taxed on both the 1.5% and you're taxed on the underlying inflation. So it's a less than optimal inflation hedge. We think a broad basket of third pillar markets is a much better choice.
Right. Rob, another question from a registrant. Do you incorporate forecasts of demographics driving a shrinking labor force as well as their deglobalization into your models?
We do. We have done pioneering work on demographics. My first paper on demographics in a major journal was in 2003. I'd written in less formal or less high-end publications about inflation all the way back to the 90s, about demographics all the way back to the 90s. And we wrote an article in 2012 in the Financial Analyst Journal that won Graham and Dodd recognition as one of the best papers on demography in the world. Cautionary note: demographics moves rather slowly. That doesn't mean that it doesn't move. And our demographic profile will be very different in 10 years from today. China's demographic profile will be starkly different in 10 years from today. There's 10 individual years along the way. So, how this plays out year by year is kind of random noise. How it plays out over a 10-year horizon becomes very interesting. Let's take China as an example, and let's set aside any possibilities of geopolitical mischief that could wreak havoc on anything I say here. You will have far fewer young adults in the labor force 10 years from now, drastically fewer 20 years from now than today. You will have far more mature adults in the 45 to 65 range in 10 years, drastically more in 20 years than today. You will have more a soaring roster of senior citizens, but today's senior citizens as a percentage of the population in China is about where it was in the US in 1950. So they do not have a demographic support ratio challenge right now. They will have a daunting one, much worse than the developed world before 2050. And the result is that transition for them will be drastic and fast. Their demographic profile is going to change more in the coming 30 years than ours did in the last 70. More than twice as much, I should say, in 30 years as ours did in the last 70 years. Implications for GDP growth. GDP growth is largely a function of young adults. Why? Because when you're 25, you know a lot more than you did at 20. When you're 30, you know a lot more than you did at 25. Your learning is fast. Your contribution to rising GDP is impressive. Mature adults are more associated with building wealth and putting it into the capital markets for future use. So, young adults are key for GDP growth. Mature adults are key for capital markets returns. The tacit implication is if young adults are tumbling in the next decade or two and mature adults are soaring, that you should see GDP growth slow markedly in China in the coming 20 years, and capital markets returns could be brilliant. All of this assumes geopolitical stability and no mischief. And if that plays out, their markets should be brilliant and their GDP growth should just unsurprisingly slow. Implications for the US are more neutral. We have among the most benign demographic outlooks in the developed world.
Great. Okay, and another question, this one I'll take. What implications does inflation have on the correlation between stocks and bonds? This is a really important question. You know, the stock and bond correlation, it's one of the more important inputs to the portfolio optimization problem. And as such, it's one of the key drivers of long horizon expectations of a balanced stock bond portfolio. A negative stock bond correlation is really helpful in the sense that it enhances diversification and reduces overall risk. And we've seen a negative stock bond correlation about over the last 20 years. Since about 2000, that's been the case. But it hasn't always been like that. Going back to 1926, the stock bond correlation was positive nearly the entire period. So in a way, the negative stock bond correlation that we've seen over the last 20 years is not the norm. Now, what drives this correlation? Well, we can look at a simple Gordon growth model to understand and uncover the drivers of the correlation. So if we look at a Gordon growth model of stocks and bonds, both stocks and bonds prices represent the present value of expected future cash flows, discounted by discount rates that include, a common component, the real rate, and um, uh, an equity risk premium for stocks and a bond risk premium for bonds. Now, what happens when you have inflation shocks? A positive inflation shocks increases the uncertainty in that common discount rate component. Uh, why is that? Well, it raises the expected future short rates, and that drives bond prices lower. But that also raises that common component, that real rate component of the discount rate on stocks. And so, this common variation in stocks and bonds, when you have positive inflation shocks, this drives the correlation between the two to increase. On the other hand, when inflation is low and stable, at that point, the equity risk premium and the bond risk premium, those are really the drivers of stock and bond volatility in that environment, and that reduces stock bond correlation. So, should we expect stock bond correlation to be negative in the coming years, or positive? Well, that really is going to depend on the inflationary environment in the years ahead. That's really going to depend on how long and sticky inflation is, how volatile it will be, and we advise investors to plan accordingly.
Let's take one more question.
Okay. Um, Rob, for a long time, there was a discussion that a long-term average of 2%, while inflation was running below 2%, that a long-term average of 2% would be okay. Why can't we live with a 3.5% inflation for some time?
Think about the core purpose of money. Money serves as a measure of the value of goods and services, measure of the value of my time as an investment manager, or a programmer's time as a programmer, or a loaf of bread. It also serves as a medium of exchange. If I want to buy a loaf of bread, I trade a certain amount of my time in investment management in exchange for a loaf of bread. It creates a common thread that allows us to value A versus B, and as a medium of exchange. It's also intended as a store of value so that you can uh, earn money today and spend money tomorrow or next year or 30 years from now. In all three contexts, the correct target inflation rate is zero. As a store of value, it would be ideal if a dollar today was worth the same as a dollar 30 years ago and a dollar 30 years hence. Measured by gold, the dollar's down 99% since 1930 in 90 years. All right, that's not very good. And of course, it's also down starkly in the last 10, 20, 30 years during a period of more benign inflation. This is a long way of saying, I think your question is leading in the wrong direction. I would challenge central bank orthodoxy aggressively that 2% inflation means that you're consciously embracing the notion that a dollar's value should fall in half a lifetime, 35 years, should fall by 3/4 in a one human lifetime. Why? I haven't gotten a good answer to why. There are some answers to why, reflecting the notion that if you have negative inflation, there's stickiness in wages and people reject having their wages come down. But what if the inflation comes from technological innovation? That's wonderful. And so if your target is 2% inflation, uh, hardly anyone would look at that and say, unmanageable, can't do it. But you get to 3.5 and you're starting to chop the value of the dollar in half every 20 years. It complicates things. Also, as Omid noted very early in the presentation, there is no such thing as high stable inflation. Inflation at 3.5 is more volatile than inflation at 2. Inflation at 2 is very likely more volatile than inflation at 0. Um, and I say very likely because there's very little history to test that against. But in any event, I would reject the notion of 3.5 as a reasonable target. I think 2 is a dangerous target. I think 3.5 is a more dangerous target, and creates a willingness to accept bursts of inflation at 6 or 8% as perfectly normal departure from a normal rate of 3.5. Heavens no, let's not go there.
Great. Well, thank you, Rob, and thank you to the audience for joining us today. Our contact information is on your screen. Please feel free to reach out to us if you'd like more information or to sign up to receive our research and insights. Thank you again.